Okay, so now let's do the perpetuity, and we'll be turning this thing on and off. But now we know that forward-looking earnings per share, 17.07, grown out at 9%, because we think that we can get earnings per share growth of 9% for Goldman again. Now I got a forward-looking earnings per share. Okay. Now what I do is I start to do some sensitivities based on the discount rate. Now the discount rate could be different types of definitions. Okay, you could use the weighted average cost of capital. You could use the average expected rate of return on the market as the discount rate. What you're going to find out is that the ranges are basically, everything's within the range. Okay, so the question becomes, what are the discount rate scenarios that you're going to use for the perpetuity model? Are we going to use 15? Are we going to use 20? No, because the expected rate of return on the market has not been 15 or 20% over the long run, and their weighted average cost of capital is not 15 or 20%. Is their weighted average cost of capital or the return on the market less than 5%? No, it's been more than 5%. Has it been 10%? Yeah, right around there. Has it been 8? Yeah, right around there. So we know that we should be using, let's say, 8%, 9%, 10%, 11%. Return on the market has been around here over time. Their weighted average cost of capital is probably somewhere in here. So now we have the four sensitivities, the four scenarios. So that's all you got to do is start to divide this by 0.11, 0.1, 0.09, 0.08 to get the valuations. So let's do that, just so that you can see what the valuation ranges are going to be. So maybe you can do the calculations and just yell them out to me, what they are. So everybody should be calculating this. So 18.6 divided by 0.11, 0.1, 0.09, 0.08. So just go ahead and yell it out.
11%, 169.
169.
0.09.
0.09, okay.
186.
What is it?
186.
186.
206.
What is it?
Next one is 206.
216?
206.
206. Just give me, just do, round it up for me. Okay, what's the next one?
206.6.
How much?
206.6.
296?
206.
Okay.
0.66.
Okay. And then the last one?
232.5.
What is it?
232.5.
232.5. Okay. So where is the current stock price right now?
196.
What is it? Where is it?
196.
191.55.
So using the perpetuity model, you can see, right? It's somewhere in there. So you have to ask yourself, really, is it really 9%? Is it 8? It's up to you to decide. I came up with a 9% growth rate. But you're going to get a different number if you use a different one. So you can use different growth rate scenarios to get different EPSs. Then you got the ranges right now for the discount rates. Boom, do the sensitivities, and then come up with an intrinsic value. What my students have done is this is the high. This is maybe they do something in between, or this is the medium. This is the low range, using perpetuity. So what's great about this is you already have one model built, okay? Now, what's really cool is that you can now do Gordon growth. This is perpetuity. Now we can do Gordon growth. So, what did we know the growth rate is not? Well, we already ran a zero growth rate scenario because that's the perpetuity, okay? So Gordon growth scenarios because your G, because you're gonna use what, EPS, T plus 1, I minus G. Well, we already got the I's, so now we need the G's. So what are the G's gonna be? What are we gonna use? Are we gonna use 0? Are we gonna use 1%? Yeah, maybe we use 1%. Do we do 2%? Yeah. 3%? Yeah. 4%? Well, there's gonna be your ranges if you want to use them. I'll tell you one thing, you use a 4% perpetuity growth rate in the EPS, it's gonna be a big number. Okay, so it's probably not 4. 1 is probably pretty reasonable because it's a really big firm. You know, it's pretty big. Actually, Goldman is not as big as JP Morgan, so actually the growth rate could, might be 2. This would be a conservative estimate. This would be most likely, and the way I look at the 3%, that's inflation. That's inflation. So over the long run, Goldman could grow its EPS at inflation. That's, I think, a highly probable scenario. And if you really think that the growth prospects for Goldman is really good because they're nimble and they're aggressive and they leverage and they do things that B of A and JP can't do, maybe there's something about them that gives them a comparative advantage to grow revenue, then maybe the growth rate, you could justify a 4. Then I think that's the ranges right there. So boom, you got the right ranges. So you got the sensitivities in the discount rates, you got the sensitivity in the growth rates, program it, and come up with the valuation. So let's just run one scenario.
Can we also check the growth rate like for 2012-13?
Yeah, you can go back in time
The difference.
and you can run historical growth rate scenarios. You can look at EBIT, EBITDA, earnings per share, on average, over time, what is the average bid? What is the, because what we're doing here, remember, this is perpetuity, the ability of Goldman to grow their revenues, EBIT, EBITDA, earnings per share, into perpetuity. That's why this thing is not going to be very big. That's why it's not going to be greater than 4, because it's just firms cannot grow their revenues into perpetuity at very high rates. Okay? So let's run one. So we already know that the forward-looking EPS is 1860. And then what do we use? What discount rate do you want to use? Does anybody know what their WACC is currently? Let's just use 9%. Let's just use 9. So we know this is 9% minus, let's do, what do you want to use, 3? 3? 3%, let's use 3%. So that's going to give you a net of 6, which basically is 0.06. So what's 1860 divided by 0.06?
310.
What is it?
310.
310? Oh. Well, Goldman is currently trading at what? 191. So I don't think so, right? You can use these numbers to kind of check, because right now the current stock price should take into consideration, based on market efficiency, of efficient market hypothesis, weak form, semi-strong, strong form, whatever you want to use. This is a way of checking. So 3 is too aggressive. So let's use 2. 2. Right? So 2 is going to be 7%, right? Or 0.07. So what's 1860 divided by 0.07?
265.
What is it?
265.
265?
0.72.
Okay, we'll do that. And now run it at where we do a 1%. So do it at 8.
232.5.
What is it?
232.5.
232. I'll just use 0. Okay, so now what you can see is that the market is using, and that's pretty close, right, to the current stock price. So the market is basically assuming that Goldman can grow its EPS into perpetuity at roughly 1%. Okay, and we already have the perpetuity approach too. So this one to me seems most likely. We've got a 9% over here, so that's 206. These are actually pretty good right there. So I got two methodologies right now that basically are telling me that the intrinsic valuations for Goldman Sachs is more than the current stock price. So right now, it looks like it's a buy. Okay. So now let's do the multiple approach. And you already know what the discount rates are here. And you already know what the adjusted Gordons are here. So you can start calculating the multiples, right? In multiples, basically just easy math on the multiples. Is we know that the current, or the forward-looking EPS is 1860, right? 1860. What we want to do now is we want to multiply it by some PE or some multiple. What was the adjusted multiple that we saw in the value line? Anybody look that up? Anybody see that? Well, we know 10 is going to probably be on the high side. 9, 8, 7, 6, and it's probably not going to be 5, right? So we know it's not 5. It's probably not going to be 6, but at least we have some multiples now to be able to apply. And this is going to be confirmed by the peer group multiples, and you're going to be able to, what you'll do is you're going to do some kind of T+1 price estimate and some EPS T+1, to get some kind of forward-looking multiple, right, that you're going to apply. So we got a forward-looking EPS, we got a forward-looking multiple. The multiple that you calculate is going to be within this range, I promise you, okay? So you're going to have to go ahead and calculate it, but I'll tell you right now, we already got the sensitivities, all right? So let's run the sensitivities, so please run the math and give me the calculations. So 1860 times 10.
186.
What? 186, okay. What is 1860 times 9?
167.4.
167.4, what about 8?
148.8.
148.8, and then 7?
130.2. 130.
50.
130.
130.2.
0.2.
Okay, I'm not even going to do the 6 because it's ridiculous, right? All right. So very quickly, well, do one more. Do an 11. Do an 11.
204.6.
204.6. All right. So here, check this out. So based on our forward-looking EPS calculation, and the current stock price is 191, right? 191. It looks like right now the market is valuing Goldman at between a 10 and 11 multiple. That's pretty good. That means that Goldman is a growth prospect, right? The higher the multiple, the higher the growth prospect for the firm. So what I like to do is I like to juxtapose the current stock price to the sensitivities and the analysis to do some sniff tests, right? So very quickly you can see the current stock price is basically valuing the firm between 10 and 11. Question is can you do a calculated multiple and justify that? I just did it through interpolation. Can you go ahead and do a forward-looking price estimate, come up with a calculated EPS, which we did, but you may come up with a different one, come up with a multiple between 10 and 11, that basically confirms that the market is probably fully pricing Goldman right now, right? But if the prospect is really 11, you calculate a forward-looking multiple of 11, the market is undervaluing Goldman right now, so there's an upside that would be a buy recommendation, right? Or call options or buying on margin. Okay. So let's continue with the EPS, 1860, and finish out the valuation. Now we want to do DCF. So we know, and again, I'm just going to do, a very simple DCF 3-year holding period. We already know 1860 Okay, so let's do it. So the question becomes, we've already taken the base EPS, grew it out one more year, so a forward-looking earnings per share of 1860. All right. So what do you think the growth rate is going to be for next year? Because we already went out 1 year. What's the next? Do you think Goldman can continue to grow its EPS at another 9%? In 2017? Can it do another 9? Yes or no?
Could be.
Yes or no?
Yes.
Yes.
Okay, so grow out, multiply 1860 by 1.09 and give it to me. 1860,
So
Well-
17.06.
no, it's not 17. It's gotta be more than that.
20.274.
20.27.
40.
Okay, we'll just keep it simple. Okay, what about 2018? Can they do another 9? Yes or no?
No.
No, what do you want to use? 7, 5, whatever?
Seven.
You gotta tell
Seven or
me,
eight.
7,
Five.
5, okay. So 20.27 multiplied by 1.05. And give me that number.
21.28.
21.28.
28.
Okay, so we used 5, okay? Now remember, we gotta grow that out one more year, because we gotta get the terminal value. So what's gonna be the next year? You already used a 5% growth rate, what are you gonna use now? 2, 3, what? 2, 3? You have to tell me. 2, okay, so multiply this 21.28 by 1.02 and give it to me.
21.71.
It's what?
21.71.
Okay, 21.71. Okay, excellent. So now I got the terminal year cash flow. Okay, now we get to, do some stuff. All right, so what was the multiple that we were using? What was the multiple that we were using? 10 or 11?
11.
10 or 11? Do you think that Goldman's multiple will continue to be 10, 11, into the future forever? No, it's probably gonna come down. So let's be conservative. So what do we wanna use? Most mature firms,
8.
multiples are around 8. So if you think that they're gonna be like the average firm, growth, mature firm, you'd use an 8. Do you wanna use something more or less than 8? Because we're not gonna use 10 or 11. So do you wanna use an 8? Or do you wanna use a 5 or a 7? You have to tell me, you're the analysts.
8.
8, okay. So now we know 8. So what's 8 times 2171?
173.68.
173.68.
0.68.
Okay, so using the multiple approach, we get a terminal value of 173.68. Okay, let's play with this a little bit more too. 21.71. What do you think its long run weighted average cost of capital would be? You think it's always going to be 9%? Do you think it'll be 10, 7? I mean, we're kind of splitting hairs, but if I'm going to use a perpetuity approach to get the terminal value, what discount rate would I use? We already know the long run rate of return or expected return on the market is 10%. Its current cost of capital is 9. What do you want to use for a terminal discount rate?
10%.
Okay. So what is, 21.71 divided by 0.1?
217.1.
217.1, okay. All right, we got another approach. Should we use the Gordon growth model? Do you think that the earnings per share can grow at a constant rate over time?
No.
Or do you want to be conservative? Because this is pretty conservative.
Let's be conservative.
Okay, so we're not going to use the Gordon growth model. Because what will happen is the terminal value will be, stratospheric. Okay. So we now know the fourth year calculated terminal value, which is the third year, needs to be added to the third year cash flow. So what's 173.68 plus 21.28? Because I need the third year cash flow. So it's 173.68 plus 21.28.
194.96.
194.
96.
96. Okay, excellent. So now what discount rate are we going to use to discount the cash flows? We already know the WAC's 9. We know the average expected rate of return on the S&P 500 for the last 10 years has been around 8 to 10%. So what do we want to use for a discount rate?
9%.
Anybody else? Okay. 1.09, 1.09, 1.09, 3, 2, 1. So will you calculate the discount factors for me? So what's 1.09 squared?
1.1881.
1.9.
1881.
You round up for me, please. Okay, and then what's 1.09 to the third power?
1.3.
1.3?
Rounded up, yeah.
Okay. So what's 1860 divided by 1.09?
17.06.
17.06, okay. And then what is 2027 divided by 1.19?
17.03.
17.03. Okay, and then what is 194.96 divided by 1.30?
149.9.
149.96.
96.
Okay, so what's 149.96 plus 17.03 plus 17.06?
184.
What is it?
184.06.
184.06. And what's the current Goldman stock price?
191.
What is it?
191.5.
191. So my question is are we using too low of a multiple? Are we not being aggressive enough in our growth rate assumptions, in earnings per share, or are we using too high of a discount? Why are we getting an intrinsic value using DCF that's lower than the current stock price?
We were mostly conservative.
We were probably too conservative. So what you're going to want to do is to review your assumptions. And if your assumptions are these assumptions, then they are what they are, right? They are what they are. But the other methodologies pointed to, higher stock price valuations. So this might be a little overly conservative, but again, it's not going to take much, right, to get to the 191 or higher than the 191. So if you look at it again and you go, yeah, DCF higher than 191, Gordon higher than 191, multiple higher than 191, perpetuity higher than 191, then we know that the intrinsic value is higher than the current stock price, and we're going to do a buy recommendation. We're going to buy calls, we're going to buy a margin, we're going to write puts, and that would be our recommendation. So you can stop it.